Einstein once said that compounding is the eighth wonder of the world. That's because anything that can compound over long periods of time will eventually grow into something massive. This same concept can be applied to companies as well, where if a business can consistently reinvest its profits, grow its cash flow, and improve over time, it will become a compounding machine that's capable of growing investors' wealth. This is also why so many great investors who focus their attention on looking for these types of companies are able to do well over the long term. Investors like Warren Buffett, Peter Lynch, and many more. In this video, I'll go through 6 criteria that you need to look out for when identifying these types of companies. With these criteria, you will be able to find stocks that aren't just higher in quality, but are also capable of delivering more predictable and consistent performance over time. Also, this video is produced in collaboration with moomoo Singapore, which is currently offering a welcome reward of up to 820 Singapore dollars. But more on that later. First, the company should have a history of consistently increasing their revenue, net profit, as well as free cash flow over the past 5 to 10 years. If a company can consistently achieve that year after year over the past 5 to 10 years, this means the company growth isn't just predictable, it's also extremely resilient and can do well regardless of competition and economic conditions. Here's an example of a company that's reliably grown their financials versus one that can't. On the left, we have Visa. Visa is a very good example of a company that can consistently grow top line and bottom line over long periods of time. As one of the largest and most dominant payment networks in the world, Visa operates a highly scalable business that benefits from long-term secular tailwinds. Visa is integrated into virtually every major payment processor, point-of-sale system, and e-commerce platform. So whether you are tapping your card at the store, shopping online, or using your phone to pay, Visa is earning a small commission from the merchants every single time. And because people will continue to spend whether it's rain or shine, in good times or during recessions, this makes Visa's business model incredibly resilient and relatively recession-proof. Not just that, Visa also sits at the center of a secular growth trend, which is the global shift towards cashless payments. As more consumers and businesses move away from cash, Visa benefits automatically, all without needing to open new stores or hire more staff. Meanwhile, Singapore Airlines can't reliably grow. Now, don't get me wrong, I love Singapore Airlines as a customer. I think their service is fantastic. But as an investor, we also need to be objective. You can see that over its history, Singapore Airlines have had trouble reliably growing its revenue, net income, as well as free cash flow. Sometimes it goes up, other times it goes down. There's zero consistency, no predictability, and we don't even have any clue how much the company will earn in the next year. Now, to be fair, this isn't the fault of Singapore Airlines. It's simply the nature of the airline industry. Airlines operate in a highly cyclical, capital-intensive business. Their performance is heavily influenced by external factors that they can't control, such as fuel prices, economic cycles, and yes, even pandemics. Add to that the high fixed cost of maintaining aircraft fleets, staff, and operations. And you have got a business where profits can swing wildly from year to year. This means even the best run airlines with world-class service and loyal customer bases like Singapore Airlines still face a tough challenge when it comes to delivering consistent financial growth. Quick pause. If you are trying to look for compounding machines, one great place to start is the moomoo app. With moomoo's smart investment tools, you'll find a wealth of useful information. The OPPO Find N5 phone is the perfect phone for that. With the world's thinnest book-style foldable and stunning 8.12-inch boundless view display, I can split the screen and run 3 apps at once. This lets me trade on moomoo while staying up to date on the latest news and doing stock research. Moomoo lets you easily find key financial data and ratios. And with moomoo's company valuation tool, you can also get a quick sense of whether the stock is undervalued or not based on historical averages. This is essential information if you wish to avoid overpaying for a stock. Moomoo also offers analyst ratings, where you get to see what Wall Street analysts think about the company, along with detailed explanations of their ratings as well as their track record. For additional insights, you can check out Morningstar ratings. This is a paid feature, but is available for free on the platform. It's one of the main sources I rely on for doing investment research. Moomoo's smart analysis tools help you track current market sentiments, money flows, and results from various technical indicators, alongside with potential buy and sell points. With the OPPO Find N5, the phone remembers the apps I like to use together and automatically suggests a split screen layout so that I can jump straight into research. And with its 5600 mAh battery, I can power through the trading day and then some. New users who sign up to moomoo Singapore get to earn up to 820 Singapore dollars worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Next, one thing that is common among all compounding machines is that they have a durable competitive advantage, also known as a moat. A strong moat gives a company the ability to protect itself from its competitors, whether it's branding power, network effects, cost advantages, or switching costs. Think of companies like Microsoft, which holds about 73% of market share in the desktop OS market, or companies like Amazon, which owns about 1/3 of the cloud computing space and over 40% of the US e-commerce. Think of Google, which dominates 70% in the search advertising market, or Booking.com, which dominates close to 40% of online travel booking industry. These companies don't just happen to grow on their own. They have deep economic moats that protect their profits and allow them to compound value year after year. Without these moats, they won't be able to grow to where they are today. So that's the kind of business that you want to look for. These are typically the market leaders in their industries, have high barriers to entry, and are incredibly hard to disrupt. This gives them the ability to compound and grow their value over time. Meanwhile, companies without a moat often struggle to defend themselves from intense competition. Take Big Bath and Beyond for example. It filed for bankruptcy because it couldn't compete with giants like Amazon and Target. Or Peloton, where its hardware and subscription model were easily replicated by competitors. Or ComfortDelGro, which saw its market share eroded as other competitors like Grab came into the picture. Without a moat, these companies are constantly fighting just to stay in the game, and you will typically see them having little to no or even negative growth. Okay, here's a pro tip. If you are researching a company and you don't know whether a company has a strong moat or not, one thing you can do is open up moomoo's app, head over to the company tab, then tap on Morningstar Research. It will then tell you whether the company's economic moat is wide or narrow, and will give you a full breakdown on why it thinks this is the case. When a company has strong brand loyalty, a unique product offering, or an entrenched market position, it typically enjoys pricing power as well. Pricing power gives a company the ability to raise prices with little to no pushback from customers, either because consumers genuinely love the products and are willing to pay more, or because there simply aren't any better alternatives available. In fact, companies with strong pricing power are often able to raise prices above the rates of inflation. This can help to not only maintain their profitability, but also increase their profit margins over time. Here, we have a company that has pricing power and one that doesn't. On the left, we have Adobe. Adobe has a history of raising prices periodically. Despite these price hikes, Adobe has seen little to no pushback from customers, even when there's other cheaper alternatives out there, such as Canva, Figma, DaVinci Resolve, and so on. The reason they can do that is because they have the industry standard for creative professionals. In fact, you can see the results in Adobe's financials. Over the past decade, Adobe's operating margin has climbed significantly, rising from below 15% in 2015 to over 35% today. On the other hand, we have Ford. Ford doesn't have pricing power because it operates in a hyper-competitive auto industry where buyers are extremely price sensitive. So, if Ford tries to raise prices, consumers can easily switch to alternatives like Toyota, Hyundai, or even the newer EV players like BYD. And unlike luxury brands like Ferrari or Porsche, Ford can't rely on brand prestige to justify premium pricing. And you can see this reflected in their margin. Over the past decade, Ford's operating margin has not only stayed flat, it is also rather low and is only averaging between -5% to 5%. This is a far cry from Adobe's margin expansion. So there is pricing power. Companies that have it will be able to grow year after year while steadily expanding their margins and earnings. And for companies that don't, they get trapped in never-ending price wars with shrinking profits and limited room to grow. Besides pricing power, Strong compounding machines also benefit from something called operating leverage. It might sound a bit cheap, but the concept is quite simple. Operating leverage is the ability of a company to grow its revenue without having to significantly increase its costs. Again, here's an example of a company that has operating leverage versus one that doesn't. On the left, we have S&P Global. S&P Global is a great example of a company that has operating leverage. A big chunk of their costs, things like software, infrastructure, data collection systems, and staff salaries are fixed. This means that expenses stay more or less the same whether the company has 10 clients or 1,000 clients. Meanwhile, their revenue isn't fixed. As more banks, asset managers, and analysts sign up for their ratings, data feeds, and analytic tools, the money that they get to earn grows, all without the company needing to spend much more to serve each new customer. Because of this, you can see that their net margin has consistently climbed over time. Sure, in 2022, there was a dip, but this was due to the IHS market merger, which came with one-time expenses, such as legal fees, severance, and integration costs. But after that, their operating margin resumed its upward trend. In contrast, Walmart is a company that doesn't benefit from strong operating leverage. While Walmart is a successful retailer, its business model requires a significant amount of reinvestment to grow, which limits its ability to scale efficiently. For example, each time Walmart opens a new store, it will incur additional costs, whether it's real estate, construction, equipment, and staffing. As the store count grows, so do the logistical expenses tied to transportation, warehousing, and inventory management. So even though Walmart may see revenue growth, its operating costs rise alongside with it. This limits its ability to expand its margins, which results in consistently low profit margins and minimal margin expansion. Because of this reinvestment-heavy model, Walmart lacks the scalability to grow, and hence, it is not a compounding machine. Moving on, one quality that is common among many compounding machines is their ability to allocate capital efficiently in ways that directly benefit shareholders. This could mean returning capital through stock buybacks, issuing dividends when appropriate, or reinvesting in high-return projects that drive long-term growth. Whatever the method, the goal remains the same: to steadily grow shareholder value over time by making every dollar count. Here, we have a company that's good at allocating their capital versus one that's not. On the left, we have Apple. Apple is a textbook example of smart capital allocation. Over the years, Apple has generated massive amounts of free cash flows and has returned a significant portion of it to shareholders through stock buybacks and dividends. In fact, Apple has been one of the largest share repurchasers in the world. These buybacks reduce the number of outstanding shares, which helps to boost earnings per share and reward long-term shareholders. At the same time, Apple continues to reinvest in innovation, R&D, and its ecosystem, ensuring that future growth is not sacrificed in the process. On the other hand, we have AMC Entertainment. AMC is an example of a company that hasn't been as disciplined with its capital. Instead of returning value to shareholders, AMC has repeatedly issued new shares, especially during and after the pandemic. While this has helped the company to raise much needed cash, it came at the cost of massive shareholder dilution. The total number of outstanding shares ballooned, and as a result, each share today represents a much smaller ownership stake in the company than it did a few years ago, effectively destroying shareholders' value. Last but not least, while strong fundamentals such as pricing power, operating leverage, and efficient capital allocation are key traits of compounding machines, valuation also plays a crucial role. That's because even the best company can become a poor investment if you overpay for it. However, this is easier said than done. Good companies are often assigned premium valuations, while weaker companies may appear cheap. On the left, we have Netflix. Right now, Netflix is trading at a PE ratio of close to 50, which makes it expensive by traditional valuation standards. The reason it's trading at a high valuation is because analysts expect Netflix to continue growing its earnings per share by 20% annually. Coupled with its history of increasing subscriber growth, improving margins, and expanding earnings potential, it's no surprise that investors are willing to pay a premium for its stock, despite the already high valuation. However, high valuations come with higher risk. While you could choose to dollar cost average into Netflix over time, buying at an elevated price can increase the risk of capital impairment. So if one day Netflix growth slows, or if its earnings don't meet expectations, the stock price could experience significant volatility. Overpaying for a stock Even a great company like Netflix raises the likelihood of disappointing returns and makes it harder to achieve long-term gains without substantial risk. That's why it's always best to buy stocks at or below their intrinsic value. The opportunities to do so are few, but they do present themselves from time to time. For example, the last time Netflix traded at a significant discount was in 2022, when the stock dropped by over 70%. At that time, Netflix only had a PE of 15. Many investors wrote off the company, saying that its days were numbered due to increasing competition. But if you could look past the irrational fear and recognize Netflix's ongoing potential as a compounding machine, you would have bought the dip and quadrupled your investment by now. On the other hand, we have General Motors, which is trading at a PE of just 7, making it appear cheap. But just because a company is cheap doesn't automatically mean it's a good investment. GM struggles to grow both its top line and bottom line efficiently. It also lacks a significant competitive moat, making it vulnerable to increasing competition. This makes GM a riskier investment, even though its stock might seem cheap on the surface. Now, there are many different ways to estimate what's a fair value to pay for a company. If you want a quick and easy way, moomoo has a Morningstar research, which will tell you what they think the fair value is and how they arrived at that number. But if you prefer to calculate it yourself, you can head over to Guru Focus DCF section. Then enter in the growth rate that you think the company will experience going forward. For the growth rate, I usually get it from several sources. The first one is at Guru Focus under the future 3 to 5 year EPS without NRI growth rate estimates. Then at FinWiz under EPS next 5 year. And finally FinChat under EPS long-term growth estimates. Calculate the average, then plug into the Guru Focus DCF calculator. And in this example, it shows that Amazon is currently at its fair value. So that was the 6 criteria as to how you can look for compounding machines. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every week.